90% of traders lose money in the markets. And you might think getting to the top 10% is really hard, but it has never been easier. And in this video, I am going to show you a simple step-by-step process that you can implement right away and start making money off of the markets. Simple, like clockwork. So expect to learn, number one, is learn how to predict the market on the daily time frame or the higher time frames. Number two is looking for those high quality entries. And then number three is making sure that we take money off of the table. You will need some tools to actually accomplish this. Number one, for me, I prefer using TradingView as my charting platform. So if you don't have TradingView, get TradingView. And then on TradingView, if you go to settings, you will see, so settings, more settings, go to events. There is this session breaks, you need to check it. So what this does is it shows you the open and the close of the day. So you know where Monday began and Monday ended, and Tuesday and Wednesday and Thursday, and like that. So now that you know where the days begin, where the days end, now we can start the process. So step one is what we call the weekly cycle. So the market will always be moving in cycles. And if you can figure out where you are in the cycle, it's very easy to make money with no stress. So Monday will always be our landmark. If you don't know where to begin, start on Monday. Now, if we go to this is Euro NSD. Monday begins here and then ends here. So on Monday, we had no objective of trading. All we wanted to do was let Monday play out. So on Monday, you can do whatever it is you want with your day. Now, once Monday closes, so Monday opens and closes, the highest point that was set on Monday, that is the high of the week, and the lowest point that was set on Monday, that is the low of the week. Now, let's delete all this so that we go step by step. So on Monday, we only draw the high and the low of the week. Now, on Tuesday begins here. So once Monday closes, Tuesday begins immediately. Now, on Tuesday, there are three things that could happen. So number one is price may just stay within the range of the high and the low of the week, which means it does not break out on either side, just stays inside. This is called an inside day. We are not interested in that. Scenario number two is price might break out. So price might continue going down like that, or price might continue going up and break out. All right, so now once we see a breakout, then we know that our system is about to be activated, because the only time we activate our system is when on Tuesday price breaks out but then closes back inside of the range. So once this line forms, because this line forms every single day, so once the day closes, the last candle, so if you look at this candle here at 1645, that last candle on Tuesday needs to be inside of the high and the low. So it looks like something like this. But you'll find in some other cases, price just closes above the high or the low. This is called a successful breakout. We are not interested in successful breakouts. We are interested in failed breakouts. Successful breakouts close outside, and then failed breakout, they fail to close as a breakout and just come back inside of the range. Now, a failed breakout is what we call a signal. And on that day when we have a failed breakout, this is what we call a signal day. And a signal day can also be called day one of the cycle. So the weekly cycle is only activated once we have a failed breakout. Now, a failed breakout if it occurs at the high. So let's write this down. So if a failed breakout occurs at high of week, that means that the next day we are looking for a reversal, so we sell. Remember, if we are at the high, we sell. And if it's at the low, we buy. So what happened on Euro NSD on Tuesday? So we will play this out and then see what happens. So I'm using the 15-minute time frame to analyze this market. And you can see clearly price has broken out. All right, so let's see how the day closes. So price has broken out and then boom, we have our close here. So if we zoom in, we see that this candle, the last candle of the day, closes as a failed breakout because it closes back inside of the range. So now we have a failed breakout. And a failed breakout at the low of the week is a reversal signal for the next day. So we will be looking for an opportunity to buy on Wednesday. So what happens on Wednesday? On Wednesday, we got that buy right off the bat and price continued going high. But we have now created a new low of the week on Tuesday. And then on Wednesday, price stays inside of the range. So this is an inside day. And price, once it stays inside of the high and the low and you already have a signal, it means that you can continue using that signal even the next day. So on the next day, I am also looking for an opportunity to buy because this is the cycle. Once you have, say for example, a signal day and then the price stays inside of the high and the low of the week, this means that you can continue with that bias on the next day and the next day and the next day until you have another failed breakout. So keep that in mind. So, and yesterday we were trading, we caught this move. And again, notice how price on Thursday closed. So this is the low of the week. Price broke out again and closed back inside of the range, giving us another failed breakout, which means that even today on Thursday, so today is on Thursday. Well, today is on Friday. So today on Friday, we are also looking for an opportunity to buy. So we can look at another example. Let's choose another one, any random pair. So this is Euro USD, and we can go back to any day, and we start on a Monday. So this is where Monday begins. So on Monday, all we do is set our high and our low of the week. And then on Tuesday, price breaks out, closes outside of the range as a breakout. No problem. We expand our high. On Wednesday, price breaks out again and closes outside of the range. We expand our high again. And we did not have any signal until on Monday again, we start the cycle. So in this case, on Monday, again sets the high and the low of the week. So this is Monday. Tuesday breaks out, closes outside of the range. Wednesday breaks out, closes outside of the range. So same as last week. So meaning Thursday we got no signal, Friday we got no signal. But notice how on Friday, again now we start the cycle again. So on Monday, we have the high, we have the low. Tuesday stays inside, Wednesday breaks out, closes outside of the range, so nothing for us. Price again breaks out on Thursday, closes outside of the range, nothing for us, again on Friday. So you'll notice that this cycle, once it occurs, it's very good, but sometimes it takes time to occur. That is why we have different pairs, so that we can already choose those ones that have the cycle in them. But then again, we start the cycle. We start the cycle again on Monday, and on Monday we have this high, this low. Then Tuesday breaks out, closes back inside of the range, giving us a failed breakout. So a failed breakout at the low of the week is a buy signal for Wednesday. Look at that. On Wednesday, we got a beautiful buy. But then price broke out and closed outside of the range. So, which means that we are not looking for any signal yet because we don't have a signal. So again, and then on Thursday, price breaks out, closes above the range. And then on Friday, price breaks out, closes back inside of the range. So think about it. We have a cycle beginning on Friday. So which means on Monday, rather than sitting and waiting for Monday and Tuesday to form, we can also trade on Monday by looking for signals on Friday. So on Friday, we have a failed breakout at the high of the week, which means that on Monday, we look for an opportunity to sell. And then on Monday, price stays within the range of the high and the low of the previous week, which means that we can continue selling on Tuesday. But now once Tuesday closes, we start the cycle again on Monday. So Monday sets that high, sets that low, and then price breaks out, closes outside of the range. So we expand our high, our low like that, and then on Wednesday, price again breaks out, closes outside of the range. Nothing for us there. And then Friday stays inside. And now today is today. So you'll notice that one pair can give you maybe 1 week of a good signal. So that is why we have different pairs. We look for these signals. So remember, the weekly cycle only begins once we have a failed breakout. For example, this one was this week. So Monday sets that high and sets that low. Monday. Tuesday breaks out, closes back inside of the range. All right, which gives us a buy signal for the next day. The next day stays inside of the high and the low of the day. I mean high and the low of the week, which means that we can continue with this bias. And that is why on Thursday we were looking for an opportunity to buy. Simple. So basically, this is how we use the weekly cycle to predict the market the next day. If you know where the market is headed the next day, it's very easy to look for setups. All right, now that you know exactly how to predict the market the next day, we also need to prepare ourselves in advance to wait for that price to move in our direction. So it's just like you seeing a vehicle up a hill. You already know the path it's going to take. So if you want to catch that vehicle, then you need to position yourself where it will meet you. So the same thing we do here in Forex. So we have to have a specific way of actually approaching this particular day so that we have that collision and we get our high probable setup. So first things first is time. We need to know exactly when is the best time for this price to move. Now, we have 3 sessions, and in each session, we give it 2 hours. So for Asia, the time that we look for setups is between 9 and 11 p.m. New York time. For London, the time to look for setups is between 3 and 5 a.m. New York time. And then for New York, the time is between 9 and 11 a.m. New York time. So on this particular day, the only time you open your computer to look for setups is between these times. Anything outside of that, that is not trading, that is gambling. So you have come to the screen at that specific time. What is your process to look for your setup? Now, let's use the example of the trade we took yesterday on GBP NSD. So if we start on Monday, Monday sets that high. So this is Monday here. So Monday sets that high and that low. So you can see that high, that low. Tuesday breaks out, closes back inside of the range, giving us a failed breakout at the low of the week, which is a buy signal for the next day. The next day, we did not trade, but price stays inside of the range, so we can continue buying the next day. So we come to the screen at 3 a.m. New York time. That is the London session. So look, we are at the London session. Here it's 3 a.m. New York time. New York time here. All right. So the first thing that we do is we identify our low of the day and we identify our high of the day. All right. Once we identify our low and we identify our high, the next step is we identify our levels. And now let's talk about levels for a while. So price will always do three things. We will always be moving up in an uptrend, down in a downtrend, or sideways in a consolidation. So this is the only thing price will do. So if we are in a consolidation, we can go down or we can go up. Like that. So this is how price moves. You never know which direction it will take, but if you have an edge in the market, you can anticipate some moves. All right. So let's say, for example, we want to sell. We want to buy, like the way we are doing here. So first things first, if we want to buy, we want to see a downtrend. Remember, we are reversal traders. So if we are reversal traders, what we want to see is a downtrend first, then we trade against that trend to reverse and go back to the other high. So we identify our high, we identify our low. Now, remember the way we said price will be going up or down. So it will create this low, high, low, high, low, high. So what we want to see is price creating a low, a high, a low, then price comes back to that high and is rejected. So price does not break above that high, but continues in that direction. This is what we call a level. So the level is where price has touched a high or a low more than twice. Twice or more. So we have one touch, we have two touches. So if we go back to our price action, we can look for that specific thing. We see that we have price going down, up, down, up. So, and remember, even the small candles count. So what this means, this one candle, is that price went up. So price went down, price went up. Price went down, price went up. Price went down, price went up. So you see this area here. This is an area where price is consolidating. All right. So if we go further to the 5-minute time frame, you can see it's a very nice place where price is consolidating. We have this level, we have this level. So this is what we call levels. So once you see your levels, so you see your levels on the 15-minute time frame, you wait. You wait. There's nothing else you can do but wait, because remember, this is what we call a consolidation. So what we want to see is either price breaking out and going up, because that is what price does, or price breaks below this low to go down. Otherwise, if you trade inside here, you are going to get cooked. So the best example occurred yesterday on Euro NSD. And you can see this because first we have a very nice downtrend from the high of the day. So the high of the day is the highest point price has reached from the open. We have the low of the day. And then we also have a pattern. So if you've ever heard of a head and shoulders pattern, we have a left shoulder, and then we have a head, and then now we are forming our right shoulder. Ooh. And then we are forming our right shoulder. So if price is correct and closes above this neckline, then we will be getting in. So we use the 5-minute time frame to look for our entry. So if price breaks above this level and closes above it, the way it did, so you can see price broke out, closed above that level. That is your entry. And then stop loss is below that candle, and then you are targeting the high of the day, as we were targeting a 1 to 5. And then you let the market do its thing. So basically, that is how you prepare yourself in that trading day. But we need to summarize everything. So write this down if you're writing this down. On the trading day, this is the process that we follow. Step 1 is time. So if you don't remember the timing window, you can rewind the video and watch it. But you have to come to the screen at that very specific time. And then number 2, you also need to draw the high of the day and the low of the day to know your range. You see, we want to see how far the high and the low is. If it's a big high and a big low, if we are trading that reversal, it means that it has a big potential. If it's small, then we don't have a big range and we don't have a big potential. Now, once you draw your high and your low of the day, number 3 is your levels. And remember, we've said levels are only levels once price touches a point 2 or more times. So like for example here, this is a level. So it's a level to the downside and a level to the upside, because price has touched it once, twice, and to the downside once, twice. This is not a level. This is a low. This is a level. So a low has 1. A level has 1, 2, or 1, 2. Simple. Once you have your levels, then you wait for your breakout. So the levels, you identify them on the 15-minute time frame. And then the entries is a 5-minute breakout candle. So once you identify your levels, you are free to go to there, and you have seen your pattern forming on the 15-minute time frame. Now you can go and chill on the 5-minute and wait for a good entry. All right, now you understand how exactly to look for high quality setups. But to make money, we need to go deeper than the setup, because there are 2 things that a lot of traders don't know that actually happen at the same time. So we have the front end of your trading, which is your price action and looking for those setups. And then you have your back end, which is your account, which also needs to grow. So you need to find a way to link the price action and the things you do on the screen, and also you need to link that to your bank account or to the money you are trading, so that you can actually grow the money. Because the goal is not to learn what the market does. Yes, you need to learn how the market does. You don't need to know everything about the market. All you need to know is this pattern occurs fairly often. And if I can capitalize on that, I have an edge in the market. So you use that edge in order for you to grow the account. So how do we focus on the back end? So now, this is where now we look at maths, because this is where if you understand the maths, then making money becomes inevitable. There is no losing. It's guaranteed to win. So let's use an example of a strategy that has a 30% win rate, which means that out of every 10 trades that you take, you only have 3 winners. But we need to make money even though we have all these 7 losers. So how do we do that? So we will use a risk to reward ratio of 1:3. So this means that every time you win 3 times as much as you have risked. But every time you lose 1. So let's play a game here. So let's say you take 10 trades. So we have trade 1, trade 2, trade 3, trade 4, 5, 6, 7, 8, 9, and trade 10. And then this is the order of how you take the trades. So remember, now this is a representation of the strategy that I have just shown you. So every time that you take a trade, using that strategy without changing anything, you follow the process from the signal day to the entry. There are 3 ways you can exit this position. So we will focus on you either hit TP or you got stopped out. So it means that you either lost money or made money. So the first trade, you lose money. The second trade, you lose money. The third trade, you lose money. And the fourth trade, you lose money. This is where now a lot of traders jump onto another strategy because they have seen 4 losses. But they don't understand these 4 losses, they are not really losses. They are just like, let me get, it's going through those bad trades so that you can find that good trade. So you have to think about these good trades. They are in some kind of a basket, but there are also bad trades. So there are other trades that look similar, but they are not that one. So you need to like go through all of them. You pick this one, it looks okay, this looks like a trade I would take. You take it, once you open it, you realize, oh, this one is bad. You take another one. You open it, you realize it's bad. But once you open the one that's a winner, so the next day, so far you in this basket, you have picked 4 trades, which let's even paint a picture of. They're apples. So you take one apple, it's rotten. Another one, it's rotten. Another one, it's rotten. But once you take the next apple, which is now the 5th apple, you find that it's a winner. So in this situation, there might be 3 apples tied together, which are maybe throuplets or triplets, whatever you want to call it. Point is, every time you take the correct trade that goes in your direction, it actually pays you more. So this is the cost of doing business. The negatives are the cost of doing business so that you can catch those big moves that will cover those losses and still leave you with profit. So this is the game that we are really playing, not the price action. So if you understand price action, you start focusing on this game. So the 5th trade is a winner. So if you see now in this situation, we have -4. So we have in our account a negative of 4R, but we have made 3R. So that means 3 cancel out each other. And now you are back at -1. So -1 is not as bad as -4. All right, the next trade you get is a loser. So you are back at -2. Then the next trade that you take is a winner. So you are back at profit now. So you're in profit, you are in +1 now. The next trade you take is a loser, and the next one you take is a loser, and then the next one, so now you are back at -1. And then the next one is a winner. And then the last one is a loser. So you find that at the end of that trading period, even though you had negatives and positives, the positives outweigh the negative, and you are at plus 2R. So if your R is $10,000, so you just made $20,000. Simple. So using this system, it's virtually guaranteeing yourself that if I just play the game, I win automatically because I already have the edge in the market. And so this is why it's very important to let your winners run. Let them hit take profit. Like for example, the trade we took here. So we were targeting a 1 to 5. We got out with a 1.45. And 1.45 is a lot of R because if 1 to 3 gives you 2R with a 30% win rate, imagine having a strategy that has a 50% win rate with a 1 to 5. That is the average risk to reward ratio. 1:5, 1:4. You will be making tons of money by just playing the game of numbers. But you must be able to first implement the simple price action strategy. You follow the rules from step 1 to the last step. That is when this game will start applying to you. So this means that we need to talk about exits. So in order for, if you get into a position, you'll see there'll be trades that will come to your stop loss immediately. And you don't need to assign any emotion to these trades because they are just numbers. So remember, they're just numbers. They don't really care about you. So you don't really need to care about them. Just play the numbers game and you will win. All right. So you will see those trades that will stop you out. Those are the negatives. It's okay. They are part of the game. But if a trade is going in your direction, this is where a lot of issues come into play. Because now you are in profit and fear comes in and you feel like, let me get out now because price might go against me. But the trade has really huge potential. So you need to have that strength to hold on to those big risks. So when I say big risk, I mean big risk to reward ratio. So in this case, you are focused on getting out of the position once price hits 1:3. If price does not hit 1:3, just count it as a loser because what's the point? So it's just setting standards. So this is where you take profits and this is where you exit. Now, you can also exit once price hits full TP, maybe 1:5, or at the end of the day. So if you got in, price stalled and moved later in the day, once the day closes, you exit all positions. That is how I personally exit my positions. So basically, what you have learned how to exit using a simple way of making sure you have money in your bank account, but also you are not emotionally attached to the outcomes because you understand this is a numbers game. You never get attached to the outcomes on the games on your phone. So it's the same thing. It's just that it's a real game that has real money. So if you truly want to understand the strategy deeper, I have a free school community. Join us and we post a lot of content, same thing, and you get a lot of resources. You also get access to me. So if you really want to change your life through Forex trading, join us on school. Anyway, if you got value from today's video, if you're watching from YouTube, subscribe and I will see you in the next video. Peace out.